Good morning and welcome to the investment meeting of the Teachers Retirement Board for October 16th, 2025. I'll start by calling the roll. Kevin Lou.
Mayor Adams, present.
Thomas Brown.
Present. Patricia, thank you. Good morning.
Anthony Giordano.
Anthony Giordano for Gregory Faulkner, Chair of the Board of Education of the City School District of City of New York. It's a lot.
Okay. John Dorset.
John Dorset, you can control Bradley.
Gary Lee.
Present.
Settings.
Christina McGrath.
Present.
Maria Cora. And I'll turn it over to the chair.
Good morning, everybody. And we will start today's meeting with the August Passport Funds Flash Report. Goldman Sachs. Great. Good morning, everyone. Good morning.
Sharing, perfect. So you'll recall that when we last met, we talked about the markets in the month of August. What we saw was roughly a 2.3% positive return for U.S. equity markets. Non-U.S. equity markets as a whole were up about 3.5%. You'll recall so far year to date, we've seen really strong returns from both U.S. and non-U.S. equity markets. The non-U.S. equity markets further bolstered by a weakening dollar. So all of that, really leading towards strong returns for not just the month of August, but also, calendar year to date when we look across the page here. The Diversified Equity Fund ended the month with $20.5 billion in assets. You can see that for the month, the fund was up 2.4%. Slightly better than the U.S. equity markets, but then also some underperformance from some of the active strategies within the fund. Calendar year to date, the Diversified Equity Fund is up about 11.8% behind the global market composite benchmark, which was up about 13%. The Balanced Fund ended the month with just shy of $700 million in assets. The fund was up 1.7% for the month, roughly in line with its benchmark as we would expect. Year to date, that fund has returned 7.4%. I commented earlier on non-U.S. equity markets. The International Equity Fund, representing about $330 million in assets, was up about 2.8%. Year to date, that fund is up over 18% through August. So very strong returns on an absolute basis there. The Sustainable Equity Fund did, with just shy of $900 million in assets, had a negative return for the month. That fund was down 2.4% and lagged its Russell 1000 growth benchmark. Year to date, that fund is up just shy of 5%, and that fund over the last 12 months, just shy of 10% behind its benchmark, which was up over 20%. So it's been quite a volatile year, as you'll recall, for growth stocks, and that's showing up there pretty notably in the Sustainable Equity Fund. And then the last two variable fund or passport fund options, you can see the U.S. Equity Index, assets over $360 million, returned right in line with the benchmark as we would expect, and the same holds for the International Equity Index, up over 50, with assets of over $54 million, also up about 4% during. So I'll pause there and see if there's any questions before we talk a little bit about September.
Thank you. Question for Mike. Thank you, Mike.
September, we saw again positive returns pretty much across the board when you look at markets. The U.S. equity market on its own was up nearly 3.5%. Non-U.S. equity markets also up across developed and emerging markets. Very strong month for emerging markets. EM was up over 7% during the month. Developed markets, looking at just the EFI index, was up just shy of 2%. So really, again, strong numbers. You take a step back and you look at calendar year to date, that really brings us to through September for a return of over 14% for the U.S. equity market and a return of nearly 26% for non-U.S. developed and emerging markets. Again, going back not only to the strength of the underlying companies and the returns of those companies in the index, but also the depreciating U.S. dollar. So I'll pause there and see if there's any questions. Otherwise, I'll hand it back to you, Tom.
Thank you, Michael. Any questions? Appreciate it. We move on to the Pension fund performance update, Steve?
Great. Thanks, Mr. Chair. I always hold my breath when Mike gives his updates, hoping that he won't just replicate everything I'm about to say. So today,
Purposely said nothing.
no, so today, your meat and potatoes update was great. Mine's gonna be a little spicier intentionally. Maybe to start off, and I'll get into the spice in a little bit. Just the first slide. Thank you. Just you've obviously seen this slide before. Unfortunately, a lot of the numbers aren't updated because we are in the midst of a government strike, which is impacting the release of economic data. But I'd say a couple of things worth note. In the third quarter this year, we do see growth slowing. And you can see here, this is actually the second quarter GDP growth reflected on the upper left-hand side. It came in at 3.3%, significantly above the contraction in the first quarter of 0.5%. A lot of it had to do with pre-tariff buying in the second quarter, and it was expected to go down quite significantly. The Fed's summary of economic projections of their dot plot for September came out with an expectation for full year growth to be just 1.6% in 2025. Inflation is rising, certainly well above the Fed's target. You can see in the lower left-hand panel, inflation more recently in August was at 2.9%. Core inflation, however, is at 3.1%, and it seems to be moving higher. A lot of that has to do with the impact of tariffs on pricing of various goods, particularly goods, not services. On the upper right-hand side, the other takeaway is that the labor market is weakening. This, again, is a little bit stale because, again, the government shutdown is not slowing down the prints of economic data. Again, looking back at August, there was an expectation for 75,000 jobs created. It came in at just 22,000 jobs and an unemployment rate of 4.3%. So a weakening of the employment picture. And then lastly, on the lower right-hand side, this is as of Tuesday, the 14th. And Mike's absolutely right in his assessment that we have seen quite a dramatic weakening of the dollar, really more year to date, but within the last month, a little bit of a rally. This is a little bit counterintuitive, but that red in the 1 month space indicates the appreciation of the dollar or the loss of value versus the dollar of the currencies themselves. So a slight strength in the dollar, again, off of significant weakness earlier on. On the next slide, a quick look at rates. Upper left-hand side, you can see that we've had an interest rate cut in September by the Fed on the 17th. There are more rate cuts being priced in and hinted at by Chair Powell and others for the October 29th and the December 10th FOMC meeting. So probably another 50 basis points coming, and that's being priced in. And you can see the green indicates where, and the negative side is actually where rates have come down in England, Europe as well. And Japan continues to have relatively low rates, but again, off of quite a period of time where they had negative 10 basis points in official rates. The yield curve is below that. I focus on the dark gray on the bottom, October 2020, and you had 30-year U.S. Treasury yields at 1.60%. And the red line, which is more recently from October 14th, up top, you can see there's, and at that point, it's 4.6% yield in 30 years. There's about a 300 basis point differential. And when we talk about higher base rates, that's what we're talking about, an upward shift in the yield curve. It's been painful to get there because it's hurt bond pricing as we move to higher rates. The good news is now you're getting more yield, more income, more carry off of your fixed income investments as a result. On the upper right-hand side, a quick look at credit spreads. Credit spreads are at or near historical tights, maybe a little off the tights, but very, very tight. Investment grade corporate bonds trading at just 73 basis points over comparable treasuries, and in high yield trading at a full 268 basis points over U.S. treasuries. Those are very tight relative to historical levels. It also indicates that there's either an element of optimism in the marketplace, an element of complacency in the marketplace, a stretch for yield because base rates are higher and people moving into fixed income, given the fact that U.S. equities are at record near high, or at or near record highs. So a lot of dynamics in the works right now. Below that, reference rates. You can see where we were a year ago. 2-year treasuries were trading at almost 4%. They're at about 3.5% today. And again, the decrease in levels has to do with both the rate cut we saw in September and expectations for further rate cuts. The 2-year treasury is more sensitive to official rates versus the 10-year rate, which is more sensitive to inflation expectations. Right now, it's a little over 4%. And a year ago, it was just about 4.10%. So not much change there. 30-year mortgages, less than 7%. We are seeing some life breathe back into the residential housing market. Now for the spiciness, gold. Gold actually is up over 60% year to date. Actually, I was checking this morning. It was trading at $4,240 a troy ounce. Silver is also at a 40-year high, trading at just a little over $53 this morning. And if you remember, the last time it traded anywhere near those levels was during the Hunt Brothers cornering of the silver market. And actually, if you adjusted that number for inflation since 1980, the price of silver should be over 200 to be comparable, and it's just at 53. But again, these are safe haven assets, so there is some information value, and then people move into precious metals at times of stress. It could be an indication, as Mike talked about earlier, the relative weakness of the dollar. That it could also be an indication that more money is flowing for safe haven assets, those precious metals, in particular gold. There's also an element of industrial demand associated with precious metals, in particular silver. There's a high silver content in solar panels, for example, and that's also driving that price higher. Now for the spiciness, does anyone know where the word, and you guys are teachers, troy ounce comes from? Troy. So I was going to say, the common man in the street would say Troy. It's actually from Troyes in Champagne, France, and it's actually a medieval convention of pricing. Where they were precious metal dealers in this section of France, where everyone used to go and do their business. The troy ounce was adopted by England by Henry VIII in 1527, and it's become convention in the States. A troy ounce actually is 9.7% heavier than an avoirdupois ounce. And the reason I mention that, and this is where it gets spicy for the teachers, it was actually talked about, if you remember, in To Sir With Love, one of my favorite movies from 1967. I can go down another tangent. That was actually
sing the song.
The screenplay was written by Lulu.
No time for.
But James Clavell also wrote the screenplay and directed that movie, and he's a very famous Shogun, Taipan, Gaijin, King Rat. Those were some of my favorite books. So, all right, that's an end of the spiciness. Next page. I just stream of conscious this morning.
That movie once.
Oh, really? Next page, please.
Good luck.
Just a look at where we are. Mike talked about this already. A lot of green on the left-hand side. Equity prices around the world are much higher. Remember, the S&P 500 was up in 2023 about 16%. 20%. It was over 20% for 2 consecutive years, up 16% last year, up about almost 13% year to date. Those are really, really strong returns. And another reason why it might make sense, Mike, for the trustees to take a look at a strategic asset allocation. The run-up has been quite substantial. Wouldn't say unprecedented, but it's meaningful. And what are the return expectations now if you look forward? Put you on the spot.
For US equities, 7
7+.
On sort of an arithmetic basis, geometric would be lower.
Yeah, so that's another reason why you want to look at your exposures. But the other side of the story is the dramatic performance outside the States, in Europe and Asia, in the middle and below, respectively. And as Mike said earlier, the weakness of the dollar certainly powered the yield. So I keep picking on the German DAX index. It's number 24 under the world equity markets. The DAX is actually up 21.68%. In local euro terms, but when you convert that back to US dollars, we bring those monies back on shore, it's up fully 36.24%. So again, an advantage of geographic diversification and currency diversification. On the right-hand side, a quick look at 10-year US 10-year sovereign yields around the world. As I mentioned earlier, US rates have come down quite a bit, really, from where they were at the beginning of the year. The top chart, you can see line number 10. US Treasury yields are 52 basis points below where they started the year. But if you look down the list, a number of the other currencies are substantially higher, particularly in France, Germany, not so much Italy, and perhaps more importantly in Japan, all the way towards the bottom, up 57 basis points as rates there normalize off of historical lows and they move away from quantitative easing. Quantitative yield.
I think the expectation is that there will be more fiscal stimulus in Europe.
Yeah.
So we can see that.
For deficit spending for debt defense spending. Yep. Yep. And infrastructure. On the next slide, just a quick look at volatility, and I'll wrap it up. You can see that obviously we had a bout of volatility early in April when the tariffs were announced by the current administration. And we see that in red in terms of the impact on the VIX, which is a volatility indicator for equities, and in green, which is volatility indicator for bonds. It's called the MOVE index. I'd say the only thing that's really noteworthy about this is things have calmed down quite a bit, but you do see on the far right-hand side a little bit of a spike and an increase in volatility for a number of reasons. There's a continued saber rattling around tariffs. There's an element in certain spots of the world, there's an increase in geopolitical concerns, although we have had some good news more recently in the Middle East. But again, something to watch. And that's it. I'll open up for questions. Anything I didn't cover? Do a little French at you, some movies, some books.
Yes,
Like the-
Thank you.
One up that.
I look forward
Like
to
like 3 weeks away.
Any questions for, oh, sorry, any other question? The professors?
Streams. I'm okay.
Thank you. So then we move on.
Okay.
That concludes our agenda. The public session, so is there a motion to go into the executive session? So moved. I'm sorry, so moved. It's been seconded.
Second.
Moved. Any questions? All those in favor of going into executive session? Please say aye. Aye. As opposed, say nay. Abstentions? We're now in executive session. Thank you. Please. Thank you. So we're back into public session. Welcome and welcome back. And we'll have a readout from TRS's Priscilla Bailey at this time. Hey, Priscilla.
Thank you, Mr. Chair. In the executive session of the Passport Fund, there was a manager update followed by an operational update. In the executive session of the Pension Fund, there was an update on preliminary performance. There was a manager update followed by securities lending update. There was a compliance update followed by 2 private equity presentations. Consensus was reached on both. Consensus was reached on the 2 private equity presentations, to be clear. There was an alternative credit presentation. Consensus was reached. Details to be made available at the appropriate time. Thank you all.
Thank you, Priscilla. I think that brings us to a conclusion of our public session. And any questions? And again, thank you, Adrian, TRS Tech Rep, and also Will, our reporter. Thank you again and again. Appreciate it. Is there a motion to adjourn? So, second. And is there a second?
Second.
Great. And all those in favor of adjourning, please say aye. Aye. Those say opposed, say nay. Abstentions. We are adjourned. Thank you, everybody. Appreciate it.